Nike is scheduled to report its quarterly financial results after the market closes on Tuesday, September 30th. In this video, I'll be doing an in-depth analysis of the company by looking at the financials, the balance sheet, key statistics, and I'll also run my DCF model to calculate Nike's intrinsic value. Finally, I'll explain the reasons why I decided to sell my Nike stock before earnings. Let's start with the most recent results. In the last earnings report on June 26th, Nike told investors that full-year revenues came in at $46.3 billion, which is down 10% year-over-year. Their gross profit margin in the fourth quarter also fell sharply, dropping 440 basis points to 40.3%. If we zoom out and look at the past 4 quarters, Nike's revenue has consistently been about 10% lower compared to the prior year. And if we switch to the annual trend, Nike had been growing revenue very steadily for over a decade, rising from $32 billion to $51.2 billion. But in the past 2 years, that growth has reversed, and revenues have declined back to around $46 billion. It's not just the top line that's been hit. Net income has dropped from $5.7 billion to $3.2 billion this year, and free cash flow has fallen from $6.6 billion to $3.2 billion. Naturally, this has put a lot of pressure on margins as well. Profit margins have slid from 11% down to 6.9%, and free cash flow margins have gone from 12% down to just 7%. The main reasons Nike has pointed to for this decline are tariffs, which the company estimates could add roughly $1 billion in extra costs, and a slowdown in consumer demand, as weaker discretionary spending has hit sales of athletic apparel and footwear. Despite the recent decline in financial performance, Nike stock has actually rallied nearly 30% since April. Much of that momentum comes from the management team's optimism about the future. Analysts seem to share this optimism. They project Nike's revenue to climb from about $46 billion today to $57 billion by 2030 in terms of revenue, and on the earnings side, Nike is expected to take a hit this year, but then gradually recover to around $4.60 per share in 2030. That would imply a forward PE ratio of about 15, suggesting the market sees Nike as having strong long-term potential despite its short-term challenges. In order to take a deeper look at the valuation, I use my DCF model, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And according to my low assumptions, Nike should be worth $36 per share, according to the middle, $63, and according to the high, $98 per share. And because the stock is currently trading at $69 per share, this means that if my low assumptions occur, you're going to make a negative 1% annual return on your money, middle positive 8.3%, and high 16.5%. By the way, these returns include the dividend because they come from free cash flow, so we cannot double count them. And I believe my assumptions are reasonable as I have Nike growing revenue between 3 and 7% in the next 7 years, averaging a profit margin and free cash flow margin between 7 and 13%, and I assigned a PM price to free cash flow at the end of the 7 years of 18, 20, and 22. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Nike's current valuation looks stretched. The stock is trading at a forward PE of 42, near all-time high, along with a PE of 32 and a price to free cash flow of 31. Based on these multiples, it's fair to say that Nike does look a bit expensive right now. That said, the company's balance sheet remains strong. Nike holds around $9 billion in cash against only $11 billion in debt, which is modest for a retailer with a market cap of $102 billion. Nike also pays a dividend with a yield of about 2.3%. However, the payout ratio is currently around 74%. This is what percentage of their profit is used to pay the dividend. That's relatively high, and it's mainly the result of their decline in profitability. So if earnings don't recover to previous levels, there's a real risk that this dividend could be cut in the future. Finally, let's talk about my position and why I decided to sell. For me, it really comes down to the fact that I feel I've already gotten the value I wanted out of this investment. I made a video about buying Nike about 6 months ago with an average cost of $57 per share. At today's price, that means I'm up roughly 20%, not counting the dividend. In my view, that's a solid return, and right now Nike looks priced as if the turnaround has already happened. While I usually invest with a 5 to 10 year horizon, in cases like this, I prefer to lock in gains when I believe the stock has already run ahead of its fundamentals. I hope you found this video valuable. Let me know what you think about Nike stock in the comments, and I'll see you in the next one.